In 2025, Disney is in the strangest place it's ever been. Not bankrupt, not irrelevant, just tired. The movies are bigger, the budgets are insane, the brands are everywhere, and somehow people care less than they used to. When a new Marvel movie drops and half the audience shrugs and says, "I'll wait for streaming," that's not a bad weekend. That's a system failure. This didn't happen because of woke or because audiences suddenly stopped liking superheroes, musicals, or talking animals. It happened because Disney changed what game it was playing. For most of its history, Disney was built to grow forests, plant ideas, nurture them slowly, let them become stories that last generations. Over the last decade, it turned into a strip mine. Take the same ground, dig it over and over, pull everything valuable out as fast as possible, and hope no one notices the land is dead underneath. That's the extraction trap, and once you see it, you can't unsee it. To understand how far things moved, you have to go back to the two competing voices inside Disney. The first voice is Walt's, the guy who would blow his own profits to make another experiment that might fail. He didn't use synergy or IP as strategy words. He talked about building worlds, not filling quarters. The money fed the art, not the other way around. The second voice showed up on paper in 1981. Michael Eisner, then Disney's new CEO, wrote a memo that people still quote today. In it, he said Disney had no obligation to make history, no obligation to make art. To make money is our only objective. On one level, that's just blunt CEO speak. But inside a creative company, that sentence becomes gravity. Slowly, everything starts tilting toward extraction. Not today, not tomorrow, but over time. The 90s Disney Renaissance masked that tilt. Little Mermaid, Beauty and the Beast, Aladdin, Lion King. It looked like the magic was back. The movies felt handcrafted. People like Jeffrey Katzenberg were still fighting for strong stories and big swings. Behind the scenes, though, something was changing. Notes multiplied, schedules tightened. The pipeline came first, and when rivals like Pixar and DreamWorks started breaking rules, weirder premises, sharper humor, Disney's answer wasn't be braver. It was do more. More titles, faster. Then came a symbolic kill shot, shutting down Disney's hand-drawn animation unit in Florida. That wasn't just a tech decision. It was a culture message. The thing that literally built the company, drawn animation, was now just another cost center that could be cut. If you're an artist who grew up sketching frames from Snow White, that tells you exactly what you are to the modern company. Optional. Katzenberg left and built DreamWorks, taking a chunk of that old-school drive with him. Shrek, a movie that openly roasted Disney, became a hit. Meanwhile, inside Disney, the safest version of on-brand started to win every argument. That's how you hollow out a creative house. Not with one big walkout, but with 20 years of the most ambitious people quietly choosing to build somewhere else. Bob Iger inherited that drift and made a decision that looked genius on every spreadsheet. If the magic had moved outside the building, he'd buy the buildings. Pixar in 2006 for about $7.4 billion. Marvel in 2009 for $4 billion. Lucasfilm in 2012 for another $4 billion. And then the monster. Most of 21st Century Fox in 2019 for more than $70 billion. In the short term, it worked perfectly. Pixar gave Disney a pipeline of emotional originals. Marvel built the most successful movie universe in history. Star Wars brought in generational loyalty and theme park fuel. Fox added Avatar, X-Men, The Simpsons, and a mountain of library content. From the outside, it looked like the smartest buying spree in Hollywood history. But there was a hidden trade. You can acquire lightning. You can't acquire the weather system that made it. Those brands had their own cultures. Pixar had story is king. Kevin Feige ran Marvel with a TV-style long game. Lucasfilm had a whole religion built around a galaxy far, far away. Once inside Disney, all of them got plugged into the same machine. Franchise committees, synergy plans, consumer products calendars, release date slots, streaming needs. The center of gravity wasn't, what's the best story we can tell anymore? It was, how does this fit the slate, the stock price, and the platform? And that's where extraction quietly takes over. Marvel is the cleanest example. For a decade, the Marvel Cinematic Universe felt like a miracle. Iron Man to Endgame was a 20-plus film experiment that somehow stayed coherent and fun. You didn't feel like you were doing homework. You felt like you were part of a giant, unfolding comic. Then, Endgame closed that chapter, and the mission changed. Marvel wasn't just a film studio anymore, it was a content hose for Disney+. Between 2021 and 2023, Marvel pumped out movies and Disney+ shows at a pace even hardcore fans struggled to track. You suddenly needed 3 6-episode series just to understand a movie villain's backstory. The fun, connected universe feeling turned into obligation. Meanwhile, the cracks were visible in the work. VFX teams started speaking out about brutal schedules. Rushed third acts looked like video game cutscenes. Bob Iger himself later admitted they'd stretched Marvel too thin and needed to focus on quality over quantity. The Marvels, released in late 2023, became the warning light on the dashboard. With a reported budget north of $200 million, it became the lowest-grossing MCU movie ever, ending around $206 million worldwide and likely losing tens of millions after marketing. That wasn't because audiences suddenly hate female superheroes. It was because the trust bank was empty. People no longer believed that a Marvel logo automatically meant must-see in theaters. They'd been trained to think, I'll catch it on Disney+. Then you have the live-action remake machine. On paper, this strategy is bulletproof. Take a beloved animated classic, rebuild it with modern VFX, trigger nostalgia, cash checks, Beauty and the Beast, Aladdin, and especially The Lion King in 2019 all put up huge numbers. Lion King alone made around $1.6 billion worldwide. But look at the creative cost. The original Lion King used stylized animation to push emotion. Big eyes, wild expressions, surreal musical numbers. The remake turned those characters into photoreal animals that physically can't emote the same way. The fur looked perfect. The faces looked empty. Audiences still showed up. The first time. Inside the building, the lesson that stuck wasn't, be careful with how we do this. It was, nostalgia is a renewable resource. Once extraction logic kicks in, the question stops being, does this remake add anything? And becomes, what else can we remake? Peter Pan, Dumbo, The Little Mermaid, Snow White, Lilo and Stitch. Some of these hit, some didn't. Lilo and Stitch in 2025 actually exploded and crossed $1 billion as a live-action animation hybrid. The point isn't that every remake flopped. The point is what it taught the company. You don't have to clear the old creative bar to get a return. You just have to remind people of when you used to clear it. That's extraction. Even Pixar, the studio that built its name on taking bizarre risks, a mostly silent robot, a rat chef, a middle-aged man sailing his house with balloons, got pulled into the same gravity. Toy Story 4 showed up years after Toy Story 3 had already landed a perfect ending. Lightyear tried to explain the real story behind a toy, confusing parents and kids and underperforming at the box office. Originals like Elemental in 2023 opened soft in the US and then slowly recovered overseas. But the overall pattern was clear. The once automatic Pixar halo was dimming. By 2025, Elio reportedly posted the worst US opening ever for a Pixar movie. Not because kids suddenly hate animation, but because parents had quietly filed Pixar under wait and see. When you train an audience to expect mid is exactly what they plan for. All of that would be bad enough. But the real extraction trap lives in the streaming strategy. Disney Plus launched in late 2019 and shot out of the gate. That cheap founding price, the entire Disney library, Marvel, Star Wars, Pixar, National Geographic, The Simpsons, it felt like an insane deal. In 2020 and 2021, subscriber numbers became the one stat Wall Street cared about. Disney leaned into it hard. By early 2022, Disney's combined streaming services, Disney Plus, Hulu, ESPN Plus, had over 200 million subscriptions worldwide. On earnings calls, executives talked about racing Netflix. The plan was simple: grow Disney Plus as fast as possible, then turn the corner into profit later. But the bill was brutal. From launch through 2023, Disney's direct-to-consumer division racked up more than $11 billion in operating losses. In fiscal 2023 alone, streaming lost about $1.6 billion even after they started trimming costs. To feed that beast, the creative side got a new primary customer. Not the audience, but the algorithm and the churn chart. Instead of asking, is this movie special? The question became, does this keep people subscribed in Q3? Scarcity used to be one of Disney's smartest tools. The old Disney Vault turned VHS and DVD releases into events. You bought the movie now, or you might miss it for years. Disney Plus exploded that logic. Everything had to be always on, and something new had to drop constantly to keep the monthly graph from dipping. That's how you end up with Star Wars series about side characters walking slowly through deserts, Marvel shows that feel like setups for other Marvel shows, and kids' content that appears and disappears before parents even realize it exists. It wasn't content, it was wallpaper. The next step was even harsher. As interest rates rose and investors stopped letting growth at any cost be the story, Disney had to prove streaming could make money, not just headlines. That's when the write-offs started. In 2023, Disney quietly removed a chunk of shows and movies from Disney Plus and Hulu altogether. Willow, Crater, dozens of other titles, not hidden, not demoted, deleted, so the company could take tax write-downs and reduce future residual payments. Imagine being a writer or director who spent years on a show, only to see it literally erased from the platform that launched it, because keeping it up wasn't worth the accounting cost. For a company that sells timeless magic, that's a loud admission. A lot of this stuff wasn't meant to be timeless at all. It was meant to plug a hole on a quarterly slide. And audiences noticed something too. If Disney doesn't even think its own originals are worth keeping online, why should you care about them? Streaming also blew up the economics of going to the movies. During the pandemic and the Bob Chapek era, Disney shortened the theatrical window hard. Some movies went straight to Disney Plus. Others hit the platform around 45 days after theatrical release. Families did the math in their heads. 4 tickets, popcorn, parking, a random weeknight, or wait 6 weeks and watch it at home for free on a service you're already paying for. Disney spent billions training its most loyal customers not to show up on opening weekend. Then 2023 hit like a report card. Indiana Jones and the Dial of Destiny underperformed and likely lost money despite nearly $400 million at the box office. Wish, the big animated original for Disney's 100th anniversary, came in far below expectations. The Marvels crashed harder than any Marvel movie before it. None of those movies were complete disasters in isolation. Together, they sent one message: the Disney logo no longer guarantees a hit. The automatic "we're going opening night" reflex is gone. By 2024 and into 2025, the picture got more complicated. Some projects still crushed. Lilo and Stitch in 2025 became a surprise billion-dollar powerhouse and set records for live-action animated hybrids. Other bets, like Pixar's Elio, fell flat. Captain America: Brave New World topped the box office, but on a $200+ million budget. Its roughly $400 million worldwide haul made it look soft compared to earlier Captain America entries. That kind of volatility tells you the brand is no longer steering the car. The individual movie has to prove itself every time. And that's exactly the opposite of what Disney spent 30 years trying to build. So if you zoom out, what do you see? First, decades of culture shifting from grow forests to harvest everything we can. Cut the hand-drawn routes, push volume over craft, buy outside genius instead of rebuilding it in-house, turn Marvel into a content syllabus, turn Star Wars into a lore expansion pack, turn Pixar into a safety net for earnings calls. Second, a streaming bet that assumed infinite appetite. Chase Netflix. Spend tens of billions, accept more than $11 billion in streaming operating losses on the way. Shrink theatrical windows. Teach people your best stuff will be at home soon. Then slam on the brakes when investors want profit and start deleting your own work for tax reasons. Third, a machine that punishes the exact thing that made Disney special in the first place: risk. You mine your old hits, your old brands, your backlog of goodwill so aggressively that there's nothing fresh growing underneath. For a while, the numbers still look good. Then one day, they don't. And you realize you've been spending down the only asset you can't quickly buy back: trust. The hard question is, can Disney actually fix this? On paper, Bob Iger knows the diagnosis. He's talked about cutting back Marvel and focusing on fewer, better projects. He's pushed for streaming to finally turn a profit instead of bleeding cash. He's trimmed costs, laid off thousands, and tried to reset expectations. But the engine room is wired a certain way. Executive bonuses still depend on quarterly metrics. Subscriber numbers, operating margin, debt targets. Those are short-term dials. Great movies don't run on those dials. Great movies need time, failed drafts, risky casting, and space to be weird. Disney has carved itself into giant brand fiefdoms. Marvel, Lucasfilm, Disney Animation, Pixar, parks, consumer products, streaming. Each one has its own priorities and its own fear of breaking something valuable. When a new project touches all of them, and the big ones do, decisions get spread across a dozen people who can all say no in different ways. The legally safest, brand-friendliest, investor-calmest version of a project is almost never the most interesting version. On top of that, Disney is locked into massive long-term commitments: streaming tech, sports rights, park expansions, multi-year slates, multi-picture deals. Canceling or delaying a movie isn't just a creative call. It blows a hole in merchandise plans, licensing deals, theme park tie-ins, and financial forecasts. So projects that everyone quietly knows are mid still go forward, because the spreadsheet can't absorb the hit. That's why fans feel like no one is listening, even when executives say the right things in interviews. The structure keeps pushing in one direction: more. More to feed the platform, more to service the brands, more to justify the last acquisition. And the audience, without ever holding a meeting or writing a memo, has started doing the only thing they can do in response. They're not boycotting. They're not marching. They're doing something much quieter. They're just not showing up the way they used to. They watch on streaming later. They cherry pick. They move their attention to someone else's tile on the home screen. Disney's crisis isn't some abstract culture war argument. It's basic physics. You can't build a system designed for maximum scale, minimum risk, and constant output, and expect it to keep producing small, specific, personal wonder on command. Wonder does not do bulk orders. If you want to see who benefits from that, look around. Smaller studios, weirder streamers, and even individual creators on platforms like YouTube and TikTok are doing exactly what Disney used to do: take sharp, distinctive swings that feel like they were made by someone, not something. Disney isn't doomed. It still has some of the most powerful brands on Earth. It still has parks people save for years to visit. It still has artists inside the building who would kill to make the next Lion King instead of the next content drop. But until the company rewires its incentives away from extraction and back toward creation, every comeback headline is just that, a headline. The real test isn't whether the next movie opens big. It's whether a kid in 2035 will still be watching something Disney made in 2025 and feeling what kids felt watching Snow White in 1937, Lion King in 1994, or Toy Story in 1995. If the answer is no, then the magic didn't just stall, it got mined.